Hello everyone, my name is Bagas Baskoro. You can call me Bagas. I'm one of MBA students from IPMI International Business School. Talking about corporate finance, it is very important topic, especially for the people who manage a business or a company. But when you heard about corporate finance, what do you think it is about? Is it about money or profit or maybe investment? Here I'm gonna share to you my learning journey about corporate finance at IPMI.
Our facilitator and lecturer is an expert on finance and investment, Professor Roy Sembel. He has experience for more than 40 years balanced work experience in business and academia. In general, I'm going to share about what are activities that we have done during corporate finance class and summary of learning about corporate finance. As implementation of student-centered learning approach, together with Professor Roy Sembel, we have many activities that involving a student individually and also as a group. Here are a couple of activities that we have done during corporate finance class. First, activity about investment simulation, where as a group we are given 1 billion of fund for investing in Indonesia stock market. Then share the performance review from beginning until end of the class. As part of individual assignment, each of us conducted company analysis about the stock that we have selected to review detail of its business, financial review, fundamental analysis, and technical analysis. And we also conduct finance research about the company to prepare a journal article draft. As a group, we also conducted book review with title The Little Book That Beats the Market by Joel Greenblatt that inform about how we should manage investment, especially in stock market. Then we also did event analysis. In my group, we analyzed about Gojek and Tokopedia merger. As combination of learning with entertainment, we review financial related movie. In this case, our group review about classic movie with the title Other People's Money. Let us move to the core learning of corporate finance. First chapter is financial management. Basic objective or goal of the financial management itself, not only about profit, but to achieve significant and sustainable value creation. And value creation is created when company generating growth with 4 cornerstones of corporate finance, in which core of value principle, conservation of value principle, expectation treatment principle, and best owner principle. Here we'll learn about principal agent problem. There are 3 main problems of the principal agent problem. First is conflict of interest, second is asymmetric information, and the third is moral hazard. As bottom line, principal agent problem can be minimized by conducting good corporate governance, or GCG, which we are familiar with term called tariff. T for transparency, A for accountability, R for responsibility, I for independency, F for fairness. We learn about importance of environment, social, and governance, or ESG, and 5 essential ways to link ESG with the company's goal to achieve sustainable value creation. We also learn from Professor Ramcharan, the book writer, about what she wants you to know about 5 business essentials, which consists of cash, profit margin, velocity, growth, and customer focus. Second chapter, we'll learn about capital budgeting, the application of time value of money, such as mortgage, time deposit, investment values, and capital budgeting itself. Capital budgeting, in general, is planning process for investment in long-term asset. In capital budgeting, we learn about compounding, estimating the future cash flow, use present value and future value, rule of 72, which we can use to approximate when your investment will become double at certain compound rate. And then we'll learn about capital budgeting concept and capital budgeting methods such as payback period, which is the classical one, internal rate of return, net present value, profitability index, and benefit ratio analysis, then apply the method in investment feasibility case study. In analysis of securities chapter, basically we'll learn about investment options that are available and the big picture of investment strategy, especially in stock market. Passive investing means investor just following the market, while active investing means investing with considering analysis such as fundamental and technical analysis. Fundamental analysis consists industry analysis for benchmarking and conducting company analysis from financial statement. We learn several methods like intrinsic value versus market price, financial ratio analysis, Dupont analysis, and we learn how to estimate return versus risk ratio investment. For technical analysis, we learn briefly about several methods like moving average, Fibonacci, support and resistance, and price pattern, which is very important to decide when to buy and when to sell the stock. We also learn about portfolio theory, which considering potential return and required return with considering risk versus volatility in the markets, use capital asset pricing model or CAPM, and how to calculate beta value. And technically, the reason why portfolio diversification is important in stock market because you will get closer to market average or closer to systematic risk. Move on to the next chapter about the capital structure, which is about long-term source of fund and financial structure. In this chapter, we discuss about debt versus equity, which we learn that usually debt is cheaper than equity, and by using debt at lower cost of financing will initially lower WACC. Benefit of debt financing is that interest is tax deductible, so it can reduce the tax payment. However, be careful because high level of debt will increase WACC and the risk of financial distress is high. We learned the key Modigliani-Miller theory, basically explain about relation of tax effect and its impact to the firm's value. And from the chart, we can see the relationship of debt ratio to the firm value. And the last one in this chapter, we will learn about optimal capital structure, which considering the balancing of tax benefit and financial distress. Next chapter, we'll learn about corporate restructuring process. It is interesting because we learn both from theory and sharing of actual experience from Professor Roy Sembel. We start this learning by understanding financial distress cycle and follow by approach and step-by-step of restructuring process to get turnaround opportunity. And then we review an interesting case about RJR Nabisco, where we learn about leverage buyout term and its mechanism. In next chapter, we learn about fraud risk management. We discuss about fraud root cause and how to prevent fraud. From fraud triangle, we learn that common root cause of fraud are rationalization, perceived opportunity, and pressure to perform. We also learn about typical example of shenanigan, which is action or design to hide or distort the real financial performance of company. Last but not least, we learn about international finance and issues in finance like Barings crisis and subprime mortgage crisis. In exchange rate topic, we learn about supply and demand between foreign and domestic currency and what factors that affecting them. We'll learn also about spot and future market. And in addition, we also discuss about dividend policy. As bottom line, although investor can benefit from capital gain, it is highly suggested that the company to pay dividend from its certain amount of earning to show this cash is really generated from company's operation and build more trust with the investor. That's all my summary of my learning. Thank you for your attention.